sovereign yield curve twisted flatter in May. Yields of 10, 15 and 30-year benchmark government bonds fell by about 7 to 10 basis points, while the yields at the short end eased by only 2 to 5 basis points. A number of positive news flow turned the sentiment and triggered the fall in bond yields. First, the government lent a helping hand by reducing the T-bill auction size by 60,000 crore till June end. They also announced several buyback of shorter dated government bonds to infuse durable liquidity in the banking system. Second, it was a huge transfer of surplus of 2.1 trillion rupees by the Reserve Bank of India. This amount was much higher than anticipated by the bond market and raised the clamor for the cut in the government borrowing this year. The third trigger was S&P's upgrade in India's sovereign rating outlook to positive from stable. This also helped the bond prices. Then reports of normal monsoon arriving on time were welcomed, as the normal monsoon will help reduce food inflation to some extent. Lastly, the report on Indian economy growing at 8.2% last year and exceeding the estimate also lifted the bond prices, as FY24 fiscal deficit was further reduced to 5.6% of the GDP. Overall, May was a good month for the bond market. Sovereign bond prices fell on June 4th, the day of election results. Sovereign bond yields hardened by about 10 basis points on the long end in a knee-jerk reaction. However, the bond prices recouped some of their losses after it was realized that the BJP was going to be able to form a coalition government. We believe that the bond prices will remain range-bound until there is a clarity on the form and substance of the new government and more information is available on the stance of the fiscal policy of the new government. To be honest, given the election outcome, some additional spending on the rural economy and the welfare is not ruled out. That said, we believe that this could provide a good opportunity for investors to lock in some current yield, as India's macroeconomic landscape remains quite favorable in our view. Average inflation is expected to be around 4.5% this year from 5.4% last year. The economy is also expected to grow at 7% plus in FY25, and this will be the fourth consecutive year of 7% plus growth in India's GDP, and that will place us in the list of among the fastest growing economies in the world. Healthy foreign inflows will also keep the current account deficit below 2% of the GDP in a second consecutive year as well. Overall, it's a great place to be. The RBI's June MPC outcome was along the expected line. The RBI kept the policy rate unchanged for the 8th consecutive time. However, the voting pattern changed marginally this time, as two external members sought a rate cut. This was a bit surprising given the sticky food inflation at 8% and the stronger economic growth momentum. The RBI also upgraded the FY25 GDP growth to 7.2% from 7% in their April policy, but kept the average inflation expectation unchanged at 4.5%. Other than that, the RBI governor was categorical that the RBI won't be blindly following the Fed in their monetary policy assessment and will be mostly based on the local economic condition and its requirement. Bond market participants interpreted this as a signal for a delayed rate cut in India, potentially in the third quarter of FY25, given that the RBI's target rate of 4% headline inflation is unlikely to be achieved this year, given the recent hardening of the industrial commodity prices and elevated food inflation in our view. Sentiment in bond market remains buoyant. The foreign portfolio investors have invested close to around 6,000 crore in June first week in FAR eligible government bonds. This has taken the cumulative investment to around 70,000 crore on year-to-date basis. Based on the market estimates, monthly FPI inflow should be around 12 to 15,000 crore starting June. Bond market participants will keenly watch the quantum of the inflows and which part of the curve the investment is being made. The weighted average maturity of 26 eligible FAR securities is about 12.5 years. The bond market will also focus on the investment pattern going forward to get clues of the additional demand in the 15 and 30-year segment of the yield curve. The consensus among the key developed market central bank is that the peak rate cycle is over. Now the focus is on gradual easing. In June, bond markets have seen Bank of Canada and the European Central Bank easing policy rates by 25 basis points each. At the same time, they are all cautious on the outlook on inflation. The last mile inflation is a bit sticky and may take longer than expected to reach the target level. Across the Atlantic, the Fed is expected to leave the rates unchanged amid strong payroll growth and the sticky headline inflation is around 3.5%, higher than the target level of 2%. This probably means that the first rate cut is likely to get delayed amid presidential elections in November. On the other hand, the Bank of Japan may be compelled to raise policy rates in a gradual manner due to headline inflation getting closer to the target level and the recent wage revision, which could boost the consumption and economic growth to a certain extent. Overall, we should expect further but uneven easing by the developed market central banks this year as long as the inflation is firmly on the declining trend. We remain positive on the Indian government bonds. The banking system liquidity, which was in deficit since March, is likely to turn positive in June-July due to structural factors and the commencement of the government spending. The foreign portfolio inflows for FAR eligible securities should also commence from June. This should create additional demand for government bonds between 1.7 trillion to 2 trillion rupees in our view. The final union budget for FY25 is also expected to have some amount of reduction in the government borrowing given the transfer of large surplus by the Reserve Bank of India. At the same time, the global sovereign bond yields should remain range-bound with declining bias as major central banks are looking to ease going forward. We expect the benchmark 10-year government bond yield to trend first towards 6.96% and then towards 6.8% from a technical perspective in the medium term. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.